Batsplaining. And I'm back. You're welcome. Today we're going to be diving into the income-based taxes, starting with payroll taxes. Not all income is the same. How you make your money impacts how much you pay in taxes. There's two main types of income, earned income and unearned income. The difference is really hinged around how did you obtain it? Did you have to work for it or not? If you had to work for it, it's earned income. If you didn't have to work for it, it's unearned. That kind of makes sense. Some examples of unearned income is rent, interest, dividends, Social Security, retirement, pensions, unemployment, alimony, the lottery, and a whole bunch of other stuff. Now, you didn't have to work for it, so you actually get to pay less in taxes. Yeah, you heard that right. You did not have to work for it, so you pay less. That sounds backwards because it is. I mean, why would the government not want to encourage people to work? Well, I think it has to do with the fact that there's some other components here at play. Number one, if you tax investments made in the economy less, it incentivizes more investment in the economy, which typically leads to economic growth, potentially job growth, and growth in GDP, and also an increase in corporate taxes that are taken in. That might be a big factor. Number two, the tax code, the way it's written, obviously wants all of us to have income that's not from working, to diversify our income streams so that we don't have to pay as much in payroll and don't have all of our eggs in the basket at our employer. Number three, political donors don't like paying taxes, so politicians are incentivized to scratch their backs, I guess, and pass laws that help their buddies out. Number four, politicians have to pay taxes too, and when they get income that's outside of their federal salaries, guess what? They don't like paying taxes either. And we all know they didn't get as rich as they are just off of their government salaries. Now, there's many reasons, but let's be honest, people don't like paying taxes, especially rich people. So, if you work for your money, you get to pay extra taxes called payroll taxes. Some examples are Social Security, Medicare, and unemployment. We're not talking about the programs themselves today, but the taxes that fund them. We can maybe do a video on the different programs, what their qualifications are, etc. down the road. Now, before we dive too much into this, I need to make a quick distinction. The IRS says there's two main types of workers in our economy. There are employees and there are subcontractors. Employees work for the company. They're paid by the company, and the company pays taxes and withholds taxes on the employee's behalf, meaning the employee only has to pay the employee portion of payroll taxes. Employees receive a W-2 at year-end, summarizing all the income that they receive from the company. Subcontractors are a person or business that's brought in to complete work at a company, but they technically do not work directly for the company. The company pays the contractor, but they do not pay taxes nor withhold taxes on the subcontractor's behalf, meaning that subcontractor has to pay both the employer and employee portion of payroll taxes. Subcontractors receive a 1099 at the end of the year, summarizing all their income that they receive from the company. So, first up for payroll taxes, we have Social Security. This tax is paid half by the employee and half by the employer. Remember, if you're a subcontractor or own the business, you get to pay both. Employers and employees each pay 6.2%, and if you're in the aforementioned category, you get to pay 12.4%. There is an income cap for this tax. For 2025, that was $176,100. So every dollar of earned income above that number is not taxed by Social Security. But this is a per person threshold. If you're married, there's a cap for each of you. If you've worked multiple jobs throughout the year, those jobs are added together. Now, your employer may have withheld those taxes, but once you hit the threshold, any excess will be refunded to you come tax time. Next, we have Medicare. Like Social Security, this tax is paid half by the employee and half by the employer. And again, if you're a subcontractor or own the business, you get to pay both. The employer and the employee each pay 1.45% or 2.9% if you're in the aforementioned category. Unlike Social Security, Medicare does not have an income cap, but instead it has an additional tax threshold. It's the opposite. Once you make over that income amount, the employee only will pay an extra 0.09% on every dollar earned. For 2025, that number was $125,000 for individuals and $250,000 for married couples. Now, I need to make a quick note here. End of last year, the Big Beautiful Bill or something really lame like that. I don't know where they come up with these names. It's insane. But there was a provision in there that everyone got really excited about called no tax on tips and overtime, which is cool. But you need to know that the no tax on tips and overtime is no income tax. It does not exclude this income from payroll taxes. You will still pay tax on everything that we just discussed, on all of your tips and your overtime. Lastly, we have unemployment. This is paid by the employer only. Subcontractors, you don't have to pay this, but you also don't get to take unemployment benefits. The federal amount is 6% of the employee's first $7,000 in wages. There is a credit that can reduce the cost if you pay your state unemployment at reasonable time, but just do the math. 6% of $7,000, that's $420. That is not a lot of money, which probably explains why unemployment benefits kind of suck. All right, now, when you're working a job, it isn't possible to completely avoid incurring these taxes, but there are some strategic things that we can do to lower the amount. It's not going to get rid of it entirely, though. Number one, diversify your income. We talked about this earlier. Can you add some income streams that are classified as unearned? Interest, dividends, rent, etc. These avoid payroll taxes altogether and give you a nice little side hustle depending on how much you're able to put towards it. Number two, fund your HSAs and your FSAs. What is an HSA? It's a health savings account. An FSA is a flex savings account. These can be for healthcare or even dependent care depending on what your employer offers. Look, these will reduce your payroll taxes as long as they're funded directly from your paycheck. Pretty sweet. Now, if you've got an FSA, I need you to remember you got to spend all the money by the end of the year. Because if you don't, the money just goes back into the corporate coffers and your company gets to keep it. Number three, track all of your business expenses. You need to keep records for all the expenses incurred in the process of making your income. Business expenses reduce your income dollar for dollar. For example, if you sold a car for $25,000, but you purchased it for $21,000, you only made $4,000. But you probably didn't even make that after you factor in paying rent, utilities, insurance, maintenance on the car. And even worse, if you had an employee sell the car for you, you might even be looking at a loss. Keeping track of these expenses is a great way to show the government that, yes, you had revenue, but the real profits that were made were not quite as high. Be honest. Keep the records. Because if you get audited, you want to have a paper trail. Number four, incorporate. Look, subcontracting is like owning a business. It's just that you, the person, are the business. Or if you're a business that's filing your taxes as sole proprietorship or an LLC filing as a sole proprietor, all of your business profits are flowing through to your personal taxes as earned income. That means every dollar of profit is subject to both employee and employer sides of payroll tax. That's 15.3%. Yikes! Now, setting up an LLC that files as an S-Corp may be a way to help reduce your taxes. Why, you ask? Well, S-Corporations have the ability to pay you as a W-2 employee. And as long as that W-2 payment is the reasonable amount for that position, any amount in profits in excess of that could be paid to you as what we would call ownership income, which is the income made from the profits of you owning the business, not from the work that you put in. Kind of like the dividends that you'd get from a stock. This income stream avoids payroll taxes. That's pretty sweet. Now, the IRS expects to receive quarterly payments of both payroll taxes and income taxes. If you're a W-2 employee, your employer has you covered, but subcontractors and business owners, you guys got to make these payments yourselves. The IRS can and will levy tax penalties and interest dated back to the date owed for all non-payment. These payments are due on the 15th of the month following the end of a quarter. So that's April 15th, June 15th, September 15th, and January 15th. Do not wait until tax day or you will be in for a big surprise. Because you're not only paying the taxes, the 15.3%, but also the penalties grow monthly and the interest compounds daily. They're going to get their money, and some on the side. That covers the extra taxes that you pay because you work hard for your money. Next week, we're going to begin walking through the Form 1040, which is the albatross of a document used to file your taxes with the IRS. I don't look forward to this. Now, what are you waiting for? Go get some passive income streams so you don't have to pay as much in payroll taxes. All right, Batman out. Thank you so much for watching this video and for supporting all of our channel. Please like, subscribe, and share this video with a friend. All right, bye for now.